Mike at Eagle Home Financial here. I just wanted to talk this week a little bit about student loans. I got a call the other day from a potential client who didn't think that they would qualify for a mortgage because they had student loans that were in forbearance. Well, this is a common thing that we see right now where due to the pandemic last year, the government put every single student loan into a forbearance, whether you wanted it or not. You got put into a forbearance. Does it affect you getting a loan? Absolutely not, unless your student loans are so high that it makes your debt to income ratio in a place where you wouldn't qualify. But just because your student loans are in forbearance has nothing to do with whether or not you qualify for a mortgage. The way that we look at it in the industry is, in the way we have to look at it, especially the loans that are in forbearance in particular, Fannie Mae and Freddie Mac have their own separate guidelines regarding student loans. Fannie Mae, we have to look at 1% of your student loan debt as a monthly obligation. So if you have $10,000 in debt, 1% of $10,000 is $100. We have to consider $100 as counting against you as a monthly debt obligation. For Freddie Mac, it's 0.5%. So if you have $10,000 again, the monthly debt obligation that we have to consider is $50. So if you're somebody who has $100,000, $150,000 in student loan debt. I've worked with clients who have upwards of $200,000 in student loan debts. It happens. We can look at the monthly debt obligation. Obviously, for a conventional mortgage, I'm going to go with Freddie Mac, so we can only consider that 0.5%. But when you're talking about $200,000, you're talking about a lot of money for a monthly debt obligation. So unless your income's really high, that's going to make your budget a little tight as far as a mortgage is concerned. So one of the things that you can do, and one of the main things that I would recommend is that you set up a payment plan, and it's called an income-based payment plan. So that, and typically what they'll do is they look at, what money you've got coming in, what money you've got going out, and they work with you on your budget and just make sure that, because they want to get their money back. And if you're willing to pay some money, they'll take your money. So they want to set up a payment plan with you. So what I recommend is the income-based repayment plan. Typically it comes with a lower monthly debt obligation, and a lot of times it's much lower than the 1% or the 0.5%, depending on the loan that we're doing, and you can afford more house. Or you could afford a house that you otherwise wouldn't have been able to. In particular, those people with $100,000 to $200,000 in student loan debts. Regardless, look into it. Make sure that you get that payment plan set up, and then get that document that says what your monthly obligation is, or what it's going to be once your payments start back up again. Any questions? Call me, text me, email me. I'm here to help. Have a great week.